So commodity producing nations are still struggling to adjust to what's been the end of the commodity supercycle and lower price environment, even though it's been improving of late, and uncertainty about demand. And they faced a hit to economic growth in some cases, also government revenues, and that in some ways has forced countries to adjust by maybe cutting spending or allowing their currencies to adjust. But in general, if we look out into 2018, this year has been a bottoming out. Next year will probably be some expansion for the growth environment. Commodity prices, energy, metals have had a recovery this year. They're not back up to mid-2000s levels, but this is a bit of a stronger outlook. So the impact on investment in this environment, there's several factors that are driving the investment outlook, depending on whether one's investing in the commodities themselves, whether one is investing in specific projects or investing in related assets. Speaking to both investors here at IMARC, but also in other gatherings, what we've seen is that these periods of difficult price environment, uncertain demand environment have led to a lack of supply. And so there's been a sorting of projects. There's been a bit of a pickup in that way. The other challenge that I think investors that we're facing now is that it's been a period of very easy liquidity. There has been a lot of cheap capital around, maybe less interested in the resource sector for the last few years, but companies have been able to finance themselves very cheaply, and they're now looking to adjust to interest rates rising. So in the work that we do at Continuum Economics, we look closely at how country balance sheets have adjusted because we want to identify countries that might struggle to cope with rising interest rates and might struggle to cope with greater volatility. And so countries that are doing reforms that have adjusted to this environment are ones that we prefer.
Sure. So the global environment for relative to the mining industry, there are really three factors that are driving it. One is the sustainability of global growth. We're now seeing a synchronized global expansion led by Asia, but with strong growth performance in Europe, in the United States, and even the laggards, places in Latin America, the Middle East and Africa, they're starting to recover. So this improved global growth has been supporting construction demand. Number two is that fixed investment, so construction, infrastructure projects, those have lagged behind a bit. So consumers have been driving this recovery. And so what's relevant for the mining sector is whether those infrastructure projects, the construction, whether those will start to outpace overall growth. If they do, then it'll be a great environment. If they don't, it might make sense to be cautious. And the third is this sort of rising interest rate environment. So the improvement in growth has helped the world exit deflation. But inflation, price pressure has been fairly moderate. And so that's allowed producers to keep their costs under wraps. There are some signs that you're starting to see some price pressures again. And so as interest rates go up, it will become clear whether all of the borrowers will be able to sustain it. So those would be the three things I'd be watching for.